Welcome to the National Credit Awareness and Resolution Association podcast at NCARA.org, your source for navigating debt repayment challenges during tough economic times. Today we'll explore how small business owners can more effectively use Creditor Tools, specifically the loan-to-value. NCARA aims to bridge the gap between debtors and creditors as a paradigm shift allows debtors to propose their own repayment solutions. Let's get started. Loan-to-values, minimum and maximum. Creditors have loan policies that reflect the level of credit risk established by the institution's board of directors. These board-approved credit policies should address the maximum loan amount by property type, maximum loan maturities, amortization schedules, pricing for interest rates and fees, and well-established maximum loan-to-value limits, or LTV limits. Exceeding the maximum LTV limits would result in there being an exception to policy. Such exceptions could be approved subject to well-documented support and mitigating factors to offset the increased credit risk. As for the LTV ratio itself, it is relatively simple to calculate. Outstanding loan balance, or the commitment amount, divided by the current appraised value. The effects of LTV in a declining market. The LTV ratios of loans secured by real estate are closely monitored by the creditor, as this ratio represents the equity cushion to protect the creditor should the primary source of repayment, like cash flow, fail to materialize. Commercial real estate loans often have 5, 10, 15, 20, 25, and even 30-year maturities, a very long time. Anything can happen to a business's cash flow, along with changing property values in any given year. A 5-year loan with a 25-year amortization will obviously have then a balloon payment at the 5-year maturity. It will have to be underwritten at the then market conditions and interest rates. If the loan was originated with a maximum 70% LTV, and market conditions have deteriorated to where the new collateral value had dropped by, let's say, 20%, the loan balance would need to be paid down to reach the new 70% LTV threshold or requirement. Regulated creditors have structured maximum LTV requirements. Typical LTV requirements for various real estate collateral types, based upon the current fair market value, include the following: 50 to 65% LTV for raw land. Again, this is for regulated creditors. Commercial investment. Okay, what does this include? Agricultural land, commercial and residential land acquisition and development, non-owner occupied commercial and industrial loans, commercial speculative, hotel, mini storage units, retirement assisted living, faith-based and auto dealership, gas station, special use properties. So these loans are a little higher risk in that sense, and therefore require more equity in the deal and have a lower LTV. The next group for LTV would be the 75% class for land development, and this would be for area or projects like single-family residential development loans, or owner-occupied single-family, or owner-occupied industrial. Someone's going to build a warehouse or manufacturing facility, or maybe even an owner-occupied office, medical, retail property as well. Similarly, for commercial development as well, for say 75 to 80% LTV for multifamily apartments and other non-residential construction deals. And then finally for single-family, 1 to 4 family residential construction loans, they can even have a little higher LTV, up to as much as 85% on improved property, of course. So loans originated with collateral having high LTVs can be considered to be a little higher risk. You'll see what happens in an economic downturn when you have a higher LTV. These thresholds are set during normal lending times, so again, the higher LTV can quickly become the higher risk. And it's unlikely the creditor will finance a loan amount more than all these internally set LTV limits, as we've just noted. As market conditions change, like I said, as they regularly do, the LTV position could deteriorate, in other words, increase, or substantially improve, depending on conditions, which means the LTV will decrease. Generally, the higher the LTV, especially in an economic downturn, the greater chance of the loan going into default. The debtor has less interest or equity in the property, right? Additionally, the less equity there is in a property, as evidenced by a high LTV ratio, the more difficult it may be to sell for the debtor or the creditor. So during an economic downturn, when the higher risks are in the environment, the higher the interest rate may need to be as well in order to compensate for that risk and the potential for loss. The lower the LTV, obviously the difference here, the more likely the debtor will step up and protect its interests, because they're not going to let all that equity disappear in the property. And this, of course, protects the interests of the creditor too. Now, what about junior liens in a secondary position behind the senior lien? How does the LTV situation affect them? In those cases where the lender might also have a junior lien, like a second mortgage or a deed of trust recorded on the same property, the creditor will measure the combined loans to the current market value, and come up with a combined LTV or a CLTV. And again, assuming that the same lender has the second mortgage, these LTV limits would have to conform to those internal policy limits. However, what about if the second lien is from another lender? It's possible that this may work to the senior lien holder's advantage. If the sale or liquidation of the collateral is necessary, and if the combined LTV position is low enough, the junior lien holder may pay off or take out the senior lien holder to protect his interests. But if market valuations are depressed, the interest of the junior lien holder will likely be foreclosed or lost when the senior lien holder takes back the property. This short ad is sponsored by the Debt Crisis Problem Podcast. Attention listeners, please join us at tuneabudget.com to tune in to the Debt Crisis Problem Podcast, where in plain English we discuss the 20 risks that could soon fuel a serious economic downturn. We explore these critical risks and offer practical insights for navigating financial uncertainty. Join us for thought-provoking discussions that encourage transparency and awareness. Subscribe now to stay informed and be ready for whatever comes next. So why is this LTV risk important to you? First, give consideration where consideration is due. In other words, think of the LTV as the risk the creditor has taken in the collateral that you pledged. If there's a 75% LTV, it means that the creditor has a 75% stake in the financing of the collateral, which leaves you financing the remaining 25% stake, even though you technically own 100% of the asset. Now let's go way up to 30,000 feet and look at your balance sheet. How much equity do you have in financing the assets versus the debt capital provided by the creditors? If the creditors have a 75% stake or 75% LTV to your 25% stake, this leverage ratio of 3-to-1 means the creditor has a 3-to-1 stake in the assets. Keep that in mind when they ask you for current financial statements and so forth. You need to appreciate who has more of a stake in the business from a capital perspective. Even if you technically own all the assets, 75% of them are at risk and subject to the interests of the creditor. So don't get too comfortable, right? This should give you a better sense of why it is so important to deal with a creditor in good faith. It matters not that the creditor may take in millions more than you do and more than you and your business do. It's about the fact that the creditor stepped up and financed your business assets 3-to-1 in this example. Those loans were given to you in good faith, and you needed these creditors to have a shot at being successful yourself. Back to LTVs, though, just remember that what goes up often comes down. Cash-out refinancings are commonplace, especially during periods of economic expansion. Business cash flows are supposed to become more seasoned over time, along with increasing property values, resulting in a decreasing loan-to-value ratio. With a low LTV level, business owners will often pull equity or cash out of their real estate collateral properties to use for a myriad of reasons or purposes. The creditor will want to advance new money because there is abundant seasoned cash flow to support repayment, as the new loan is still well collateralized and within acceptable LTV position, and sufficient cash flow support to make everyone happy. But like I said, what goes up often comes down, and when real estate values decrease, especially after a cash-out refinance, it's possible the maximum LTV position will be compromised. That in and of itself is not a reason for the creditor to be overly concerned if the documented cash flows still support repayment. After all, the collateral is not the primary repayment source, as it is only the secondary repayment source in case the primary source fails. When it does fail, then there's a problem and reason to be concerned. Suddenly, loans may become impaired, subject to regulatory scrutiny, a potential shift in the interest accrual versus non-accrual status, a sale or liquidation of the collateral, and so forth. The debtor must understand the position and thinking of the creditor when it comes to the collateral and maintain open lines of communication as it prepares its debt repayment strategies. Next, as pressures build. In a serious economic downturn, both the creditor and you may need to think more carefully about each other's position and give each other more respect, maybe a lot more respect. Too many such relationships become strained and ruined when stresses increase. On the one hand, creditors simply want all their money back. You are just trying to survive with a high collateral LTV. But between the time they loaned you the money and when they get repaid, you have an opportunity to become very engaged, show actual ownership of your responsibility to repay, regardless of the high LTV position. Lenders can work with you under a higher than normal LTV situation, but you need to empower your voice in what happens down this journey as to how and when those debts are going to be repaid. You have too much to lose here, okay? Perhaps everything. That's precisely why you must be empowered to repay your debts as best you can. Understanding the current LTV position and any potential loss the creditor may face will help in coming to a mutually acceptable repayment solution. Creditors need to remember that you are a human being and not just a number or a name on a report. But the better report prepared you are, the better chance you have to come up with a prudent repayment solution the creditor will agree to and avoid further problems. Thank you for joining us today. We covered the Creditor Tool, Loan to Value, as debtors prepare to propose their own repayment solution. But we want to hear from you. Share your own credit risk memo and debt repayment experiences, questions, and recommendations with us at NACARA.org. If you found today's episode helpful, please subscribe for notifications for future podcasts. Your feedback helps other small businesses stay in business too. Until next time, please step forward and take responsibility for your own debt repayment solutions. Thanks again.